me ask you something simple. If you had the power to control India's money, how would you use it? Would you print more money? Would you lower interest rates so loans become cheaper? Would you tighten rules if banks start taking big risks? Someone actually has that power, and that someone is RBI, the Reserve Bank of India. In the last episode, we saw how RBI is the most powerful regulator in India's financial world. But today, we are going much deeper. Because RBI doesn't just regulate banks, RBI controls how money flows, how lending works, how payments function, and even how fintech companies behave. So in this episode, I'm going to explain what RBI really does in the simplest possible way. Let's start with one question. Why does a country even need a central bank? It's because money is extremely fragile. If too much money is printed, price skyrocket. If banks give risky loans, people lose their savings. If payment system fails, the entire country stops. So RBI exists for one big reason, to keep India's financial system stable, safe and predictable. Everything RBI does, every guideline, every rule has one purpose: protect the economy and protect the common person. Now let's break RBI's responsibility into 6 buckets. Bucket number 1, monetary policy. Imagine the Indian economy as a car. RBI is the person controlling the accelerator and brakes. This is called the monetary policy. RBI adjusts the economy using tools like repo rate, the rate at which banks borrow from RBI. When repo rate goes up, loans become expensive, inflation goes down. When repo rate goes down, loans become cheaper, economy speeds up. CRR, how much money banks must keep aside. Higher CRR equals to banks lends less, risk reduces. Lower CRR, banks lend more, growth increases. Open market operation, buying or selling bonds. This controls how much money flows into the system. So RBI is constantly adjusting these levers to make sure India does not face runaway inflation or sudden crashes. Second bucket, licensing authority. Not everyone can start a bank, not everyone can start a lending company, not everyone can run a payment app. RBI decides who gets to enter into the financial system. It gives licenses for banks, small finance banks, payment banks, NBFCs, prepaid wallets, payment aggregators, and card networks. Why does this matter? Because if a company handles public money, RBI must make sure they are safe, clean, and capable. Think of RBI as the strict gatekeeper deciding who can play in the money field. Bucket number 3, supervision and audits. Giving license is not enough. RBI also keeps a very close watch on these entities. It continuously monitors whether banks have enough capital, whether NBFCs are lending responsibly, whether companies follow KYC and AML rules, whether customers are being treated fairly, whether any fraud or risk is building up. If RBI sees danger, it can stop new loans, restrict operations, impose penalties, shut down companies, and even merge weak banks with stronger ones. This supervision is the reason India rarely sees any bank collapses, even when the global market goes through crisis. Bucket number 4, payment and digital infrastructure. Every time you use UPI, IMPS, NEFT, RTGS, or even a debit card, RBI is silently involved. RBI doesn't run the apps, but it creates the rules and oversees the entire infrastructure. It ensures transactions happen securely, banks settle money correctly, fraud is minimized, payment companies follow compliance, digital payments stay stable. Even NPCI, the organization behind UPI, operates under RBI's oversight. So the reason India's payment system are fast and reliable is because RBI keeps the entire network in line. Bucket number 5, lending rules and digital lending. This is where many people get confused. RBI does not give loans, but it decides how loan must be given. Some examples: guideline for loan product, FLDG rules, fair lending practices, interest rate transparency, recovery guidelines, data privacy rules, digital lending frameworks. RBI ensures lenders do not overcharge customers, hide fees, misuse data, use unfair collection practices. This protects borrowers while keeping the lending industry healthy and sustainable. Bucket number 6, consumer protection. At the end of the day, RBI's biggest job is simple: protect the user. It ensures your deposits are safe, your digital payments are secure, your loan terms are fair, your data is not misused, your rights are respected. Tools like customer grievance guidelines, fraud detection framework, data localization requirements all exist to protect the customer from a powerful financial institution. RBI is the invisible shield behind every financial transaction you do. Without RBI, the financial system would drift into chaos. Banks could take dangerous bets, fintech apps could misuse data, lenders could trap customers, payments could break, inflation could run wild. RBI is the reason India's financial world feels predictable, trustworthy, and stable, even during global uncertainty. It is the backbone of Indian finance. Now that you understand what RBI actually does, there's one more question. Who does RBI regulate? Because under RBI, there are an entire universe of banks, lenders, wallets, and payment players, each with different rules, powers, and limitations. So in the next episode, we are breaking down every type of bank in India. Public, private, payment banks, small finance bank, foreign banks, and more. If you're an aspiring product manager, this knowledge will become one of your strongest foundation. So hit subscribe, drop your question in comments, and I'll see you in the next one.